On the Investopedia Express this week, the vibes are high and we are trading on. This bull market, though, is looking very skewy. Unemployment creeps up the income chain. Schwab's Kevin Gordon drops in for some strategy for a few good minutes later on in the show. And IPOs are so back, baby. The Investopedia indicator and what to watch this week. Microphone check 1, 2. What is this? It's the Investopedia Express, all up in your business. Welcome back and welcome aboard to the Investopedia Express, streaming live all over the social platforms and then on demand wherever you get your podcast. Thanks so much for joining the show on a Monday morning. Market's a little soft coming into a week after dancing around record highs last week. We did have a record high for the Dow, though, and we'd love you to join the conversation. So chime in from wherever you are all over the world. We know we got worldwide listeners and viewers from Trinidad to India to Taiwan to Tobago, everywhere you are. We'd love to hear from you. Thanks so much for joining the Express. We got a pretty packed show today, a lot going on in our little world of investing over here. But guess what? The vibes are high. As I said, investors as optimistic as they've been all year, according to our most recent sentiment survey. And as I said earlier, the vibes, my friends, are immaculate. You got 67% of people saying they are optimistic, cautiously optimistic, or very optimistic, extremely optimistic about their investments right now. Again, that's a high for the year. And why wouldn't they be, right? We got near record highs for stocks. That'll do that to you. We got risky assets surging in price. We got that going on. We got the potential for lower interest rates. Could be a good thing, could be a bad thing. We'll see how that ends up panning out. We also have a pretty favorable tax environment for our corporations to profit. And we also have a very intense deregulatory environment as the gates are open for companies to print as much profit as they want, as long as they are playing it straight with this administration. So you got record highs. We're going to dig in to the results of our sentiment survey a little further down the show when we get Kevin Gordon from Charles Schwab on the program. But basically, investors feeling pretty good right now. And when you look at the top performing asset classes this year, you got risk assets at the top of that chain. We got Bitcoin up nearly 28%, falling a little bit this morning. All cryptocurrencies trading off this Monday morning to get things started on the week. But still, Bitcoin, the top performing asset, and I put that in air quotes, so far this year. Next to gold. Rare that Bitcoin and gold perform so well together. Sometimes people think they're decorrelated. We used to call Bitcoin the digital gold. We don't call it that anymore. Bitcoin is Bitcoin. Stocks up about 14.5% so far this year. We've been through a lot. We've been through it, almost got to a bear market, but we didn't, 19%. But we've been bouncing back pretty strongly, and it's been pretty broad, this rally, even though it's heavily concentrated at the top. Investment grade bonds up a little better than 8.5%, and high yield bonds up 27.5%. That tells you that investors have some risk appetite right now. And you know what? This bull market, though, kind of getting a little bit old. I'm not being ageist over here, but this bull market in terms of time period is getting on in years. This from our friends at Bespoke Investments. This bull market on October 12th, 2022. I remember it well. It's now up 81% since then. That's 4 percentage points above the median bull market gain and about 35 percentage points below the average bull market gain of 114%. The length so far at 1,038 days has now eclipsed both the median bull market, 522 days, and the average, 1,011 days. But bull markets that make it past the 1,000-day mark have historically lasted much longer than that. It may be old, but it's strong, and it might be getting stronger. And look at this chart here. Go back to that for a quick sec from our friends again at Bespoke. This compares the performance of the NASDAQ back in the Netscape era, when it went public around the end of 1994, and what happened with ChatGPT when it hit the mainstream, so to speak, at the end of November in 2022. That Netscape run was much stronger, about 120% through 678 days. ChatGPT, everyone's excited about AI, about the spend, about all these new companies that have come to dominate our markets. Well, in terms of market gain, it is actually trailing the Netscape gain. So that's very fascinating when you think about historical performance of industry-changing events. And Netscape, the browser, The Mosaic browser was a industry game changer, but ChatGPT has really revolutionized the game. But stock performance has not been as strong as back in the Netscape days, and there are actually fewer stocks out there. And we had a little bit of a bubble in 1999. But the good news for investors, though, is we got a bullish skew. Yeah, Investopedia term, love that. A bullish skew in New York Stock Exchange breadth. We're talking about the stocks that trade on the stock exchange. There are over 2,500 of them. And you're looking at more advancers than decliners when you look at the NYSE. And the NYSE's got a pretty broad index there. Not all tech companies, hardly, though they've had a lot of tech and AI and cryptocurrency IPOs lately. But that's good breadth when you get that skew, right? More advancers leading than decliners. We like to see that in a healthy bull market. And as I said, this bull market may be getting old, but it's still got some strength in it. The economy, though, may be heading in an absolutely different direction. We all know this. Stock market and the economy going in different ways. But when you look at stocks making all-time highs, you get pretty good breadth there. I didn't just look at 52-week highs. I didn't just look at 3-year highs or 5-year highs. I wanted to see stocks that were performing as best as they ever have in their entire careers as publicly traded companies. And there you have it. eBay, Goldman Sachs, Reddit, Meta, Lowe's Corporation. I'm not talking about the place you get your hardware on the weekend. I'm talking about this diversified company that owns real estate assets and other companies, retail assets as well. They're big, of course, hotel company, but they're pretty strong right now. And Smithfield Foods, hey, I see bacon there. I see Meta advertising. I see banking, and I see Reddit on the internet. I see that as a pretty strong bull market when you look across sectors and you look at what's doing well. A lot of stocks doing pretty well right now, not just the Mag 7 or the top 10. That said, the economy, though, may be heading in a different direction. I don't want to be Debbie Downer on a Monday morning here, but we got to be realistic. And we know the stock market and the economy heading in different directions most of the time. They sometimes show up at the same picnic, but right now I'm looking at rising inflation. We got those consumer price index and the producer price index reports last week. We saw signs of tariffs bleeding in there. We saw higher services wages. We saw higher services actually driving PPI higher. We saw in consumer prices. You didn't see it so much in the apparel area. You do see it in automotives and other areas, but you do see inflation ticking higher here. We got a weakening labor market. We know what happened with those prints back in July, and we know about those revisions in May and June. But we're also seeing rising unemployment claims by middle to income households. And when that happens, you see spending start to taper off. That can become a concern. Good chart there from our folks at B of A, the B of A Institute there. Unemployment claims rising for middle to higher income households. And not only that, we got bankruptcy filings starting to tick higher. And a good chart here from G2 Risk Solutions. They're ticking higher in all kinds of interesting parts of the country. The North Central, Northeast, we got them on the West, we got them down South. So bankruptcy filings ticking higher, unemployment softening, and prices ticking higher. All of that could set us in for a little bit of a tailspin here. That said, don't tell investors because they're pretty bullish on the stock market right now. All right, thank you very much, Miss Pac-Man. It's not game over yet, but we got a lot to get through on the show. We're going to bring in our good friend Kevin Gordon from Charles Schwab. He's the director of research over there, senior investment strategist. Let's bring him in for the drop-in. Kevin, so good to have you on the Express. Thanks so much for joining us. Appreciate you.
Yeah. Hey, Caleb, how are you? Thanks for having me.
Well, we're big fans of Schwab Research here. We love the work that you do, you and the team over there. But I've got to ask you, given all this optimism lately, given the fact that we're still dancing around record highs and there are tremors and there have been concerns about tariffs and everything else so far this year, are you surprised at the optimism among individual investors and even among institutional investors? Because we know that institutional investors are pretty bullish right now as well.
Yeah, it's interesting when you talk about optimism. I think you really have to sort of be specific on what part of the market or what survey you're looking at, or even on the behavioral side of things, where you actually look at in terms of equity market positioning. And positioning, I would say when you combine everything, whether it's ETF flows or into mutual funds or single stock exposure, you're not really at what I would think of as ultimately euphoric or terribly optimistic levels. I think that sentiment's sort of inching into that complacency territory, but evidenced by some of the surveys you were showing from your own, whether it's the cautious optimism bar being really high or even some of the skepticism, still being relatively elevated. Even in attitudinal surveys, we're not necessarily seeing this huge spike in bullishness, and that's been evident even in something like the AAII survey. And you look at the percentage of bulls, it's actually been rolling over, and it hasn't been consistent with the market continuing to move higher and us continuing to kind of resume the march to new record highs. So I wouldn't keep investor sentiment in the worrisome column right now or in the risky column. I think that there's probably still some more room to go in terms of investors chasing the rally, if you want to think about it that way. But that's consistent with sort of the backdrop we've had for the market over the past couple of weeks, which is when you have some skepticism and when you have some caution in the market, that tends to be consistent with that so-called wall of worry that investors tend to climb, and that means that the market does historically pretty well in that scenario.
Yeah, the VIX has been pretty low. We know the fear index has been very low, except for a couple of moments when it was headline risk that really made it shoot up. But it's been sort of a slow churning market higher to higher highs, especially since the relaxation of a lot of those tariffs in mid-April. There, a little more smoke than fire. What are you seeing in terms of? I know you guys do such deep dives on the economic reports, but you also do a lot of channel checking in terms of the impact of tariffs. More smoke than fire lately. Have we not seen nothing yet?
Well, there's been some fire in some of the more cyclical parts of the economy. I mean, you look at earnings season for the second quarter, you really did have this huge and broad spectrum between companies that were relatively insulated from tariffs in terms of the direct hit to their companies. If they weren't making products or if they weren't having a heavy bias towards foreign inputs and imports, then they probably weren't hit as much. And you actually saw those companies continue to do well, not just in terms of their stock price, but in terms of actual corporate fundamentals. And some companies actually, restoring guidance after having pulled it early in April when they were reporting first quarter earnings. The ones that have been more at the epicenter, autos was sort of I think the standout and the poster child for it in this most recent reporting season. They definitely have been reporting, taking a hit from tariff-related costs and having a much stronger impact there. It's just the tough part about analyzing this at the aggregate, economic level is that those more cyclical industries, and autos in particular, they're just a smaller share of the economy. So yes, there are ripple effects when you have, manufacturing and everything factory oriented, but we also know that in the post-pandemic era, those linkages have, if not broken down, they've just been elongated. So when you start to see a hit to that part of the economy, it's not necessarily a hard and fast rule of X months after that you start to see a weakening of the rest of the economy. We've been in this really interesting, what we've been calling a rolling recessionary environment where parts of the economy, whether it's housing, whether it's manufacturing, consumer sentiment, housing sentiment in general, that's been weak and at times at recession levels, but that hasn't filtered over to the rest of the economy. Importantly, the services economy. That's pretty much what you're seeing in this entire tariff dispute, not only because the tariffs are rolling in nature, so it's still taking a while for us to figure out what some of the sectoral tariffs look like and where we ultimately end up, but mostly because the companies and the industries that are at the epicenter of the trade war, they're not the largest share of the U.S. economy.
Sure. We don't buy a car every week either. We do fill up our car with gas, and gas prices have been relatively tame. And I think that's kind of been softening consumer prices in general when you look at the core, and also when you look at retail spending in general. If we're not spending $75 to fill up our cars, that money goes a little bit further. Let's go back into our portfolios for a second, because we like to ask our readers here at Investopedia, what are your top holdings? What's in your portfolio? What are you buying? What are you continuing to buy, and what would you continue to buy if you had some more money? And it looks just like the top of the S&P 500. You see the biggest stocks there. NVIDIA obviously dominating. It's a $4 trillion company, but you got your big ones there: Apple, Microsoft, Palantir. They've been with the winners, and they like to stick with the winners, and they like to stick with the stocks that brought them to the dance. But our friends down in Malvern, PA, did a study that said that we are kind of overstuffed with stock. When you look inside our 401ks and you look inside our defined contribution plans, we are heavily weighted in stock. When you talk about individual retail investors, 88% of our 401ks in stock versus 82% a decade earlier. Are you worried about overconcentration of stocks when our portfolio should be a little bit more diversified right now?
I think that the diversification issue, it certainly depends on how much you sort of want to mimic or how much you're following the indexes. And this is an important distinction we always make for, individual or retail investors versus institutional. We're much more in service of the former, category and when it comes to our clients. And we always impart the notion and the reality that looking at an index or trying to track an index and having that same constitution of the index, that's an institutional problem. That's not a retail problem. So you don't need to have this sort of emphasis on the mega caps or having a large, portion of your portfolio necessarily being, just a handful of stocks because, you were just pointing out performance this year. It's not the case that the mega caps, at least in the case of the S&P 500, are the best performers in the index this year. And actually, if you look at the group, the Mag 7, those 7 stocks, none of them are in the top 10 performers list for the S&P 500 year to date. That doesn't mean they're bad companies or vice versa. It just means that there are other opportunities for relatively significant outperformance if you are of the more individual stock picking mindset that you can find outside of that group. S&P 500, as just in general as a benchmark, is larger cap in nature. But within that sphere of large cap, it's not just those companies that maybe are valued more than $1 trillion or slightly below that that have been doing the best. And that's a really important distinction, I think, in today's market environment, because yes, you look at the top 10 companies in the S&P 500, they make up 40% of the index in terms of market cap. That is a pretty significant, concentration risk in terms of them turning lower and having an outsized impact on the index and vice versa. But that doesn't necessarily mean that as an individual investor, you need to mimic that and have that same setup in your portfolio. There are investors who like that and prefer that, and that's totally fine. But I think that, understanding that they're not the best performers, they just have the largest contribution to the index because of their weight. That's a really important distinction, especially at a time like this when breadth still looks relatively solid. To the point, the chart you pointed to earlier from Sentiment Trader, breadth has been pretty solid in this run since the early April lows.
Yeah, you got to have good breadth if you want to have a sustained bull market. Otherwise, we know it gets a little top heavy. There's that skew, bullish skew in NYSE stocks. We love that. So yeah, from Sentiment Trader, great stuff there. So I would love to know from your perspective, what does diversification really look like now for a retail investor? Talk to me about someone in their 30s or 40s, and they want to be diversified, but they look in their portfolios or they're buying the large cap mutual funds or index funds through their 401ks or through ETFs. How do you really diversify in 2025?
Well, I think that, a lot of diversification efforts have to be centered around what's your financial risk tolerance? What's your emotional risk tolerance? And I think that's become a really important factor in the past couple of years because I've talked to a lot of investors, particularly those who skew younger and they're down the age spectrum, who will tell me that, they're totally fine taking a lot of risks. They don't mind volatility. But then they're sort of the first ones to call me or shoot me a note when we have a 5% pullback in the market and they, start to feel a lot more tremors. And, to that I answer, you probably, for anybody that has that kind of feeling, not, it's not any targeted advice towards one individual, but if you find yourself in that position, you probably should assess the difference between the two, your financial risk tolerance and your emotional risk tolerance. I think that's an important distinction. Beyond that, though, and sort of, I would say somewhat related, and this is something that's changed, this well, something that's changed in the post-pandemic environment. The bond market as a diversification tool has become, I think, much more additive for the average investor's portfolio. Pre-pandemic, that post-financial crisis run expansion up until the pandemic, bond yields were pinned very low, not just in the US, but around the world. Now that we've got some inflation heat again, yes, there's downside to that in terms of the economy. We all learned that from 2022 into 23. But now with yields having been elevated for a couple of years now, and the fact that you're getting a much stronger coupon on the side of in the bond market, that's a pretty strong, ballast for a portfolio. And for all the consternation around global risks and global growth risks this year, it's actually international developed bonds that have had the strongest returns in the fixed income universe year to date. So there are a lot more opportunities outside of the stock market, which is where I live and what I cover. But when I talk to my colleagues on the fixed income team, we're still really sort of pounding the table and emphasizing the benefits and the diversification benefits you get from inching out into the bond market. So I think particularly for younger investors who, maybe only know the stock market because it's what is, maybe a little bit more popular or just more widely known because of some of the runs that, meme stocks or kind of these more crypto adjacent stocks have had over the past couple of years. I would say, take as much time, if not more, to understand what's going on in fixed income and how there are more beneficial opportunities there, especially when it comes to diversification, because it really comes in handy, when correlations go the other way, when you do go into a sell-off and you have that cushion from bonds, that helps soften the blow sometimes when you go through these pretty significant drawdowns like we've had in mega cap tech and, some of the more speculative, riskier parts of the stock market.
Yeah. Well, you mentioned international bonds. International stocks doing pretty well too. The best
Yeah.
performing markets in the world, not here in the United States, a bunch of them over in Europe, and many of them might surprise you. Surprise at the end of this show for folks tuning in. Shout out to our viewers in Tanzania and Mexico and all over the world who are chiming. And there you go. Chevy's in the house. If you can tell me at the end of the show, KW, the best performing stock market in the world, the best performing ETF in the world, I'll send you a pair of Investopedia socks. So join that conversation. A little surprise there at the end of the show. Let's talk about long-term expectations. Kevin, you guys do such a good job at Schwab Research about tempering expectations, but also giving us a realistic view of what we should expect as investors, especially in the U.S. equity market. We've come through a period of 14% annual returns, even higher when you look at it over the past 3 or 4 years. The returns are getting bigger. Should we expect that going forward, though, given the world we're living in today and how things are changing?
Yeah, any long-term expectations model or data set you'll look at that's put together right now, it won't have as strong of expectations looking forward, whether that's the next 5 or 10 years. Most of that is based on valuation. You look at where valuations are today, whether it's the S&P 500, especially something like the NASDAQ. A lot of that mega cap growth, tech-related exposure, and the fact that that's just a growing share of the market. I mean, because those companies tend to have much, higher and more stretched valuations. They're the ones that tend to have sort of the weightiness aspect of putting downward pressure on expected returns looking ahead. Of course, you can back up the past 10 years when a lot of those companies or industries and parts of the stock market were, still relatively overvalued. But of course, 10 years later, we're sitting on some pretty nice gains, even with a lot of chop along the way. So I wouldn't necessarily take that as gospel and some sort of hard and fast rule that we're not going to have strong returns moving forward. But to the point we were just talking about around diversification, I think it makes a stronger argument for having a more balanced and more diversified portfolio, especially because tech and tech adjacent is such a large share of the stock market today. You can argue, depending on what industry you're putting in there into that mix, you can argue it's more than half the market, depending on where you are in the cycle. So I think that's an important thing to keep in mind, especially because when you look at household exposure to stocks or just assets in general, we're pretty much at an all-time high. And we've got data from the Fed that goes back to the 1950s on this. You can map that with rolling returns for the S&P 500 over the past 10 years, and you can do that lagged effect where you can see that anytime the market gets this overvalued or anytime you see household asset or equity exposure get this high, forward returns in the next 10 years tend to be pretty weak. Again, not a hard and fast rule, not one relationship that rules them all in terms of what we have to expect for longer term expectations. But I think it's another reason to explore more opportunity, not just within the stock market, but also, again, within areas like fixed income or other asset classes. So it's an important thing to keep in mind. But I will say, even though tech and those parts of the market have grown their share significantly and are essentially at an all-time high right now in terms of their makeup of the S&P, that's also as the economy has transitioned from being more manufacturing based decades ago and more cyclical based to more services and software and innovation based. So it's not like that's been an unjustified move, but you can get to points where sometimes the gap is a little wide, where performance or price runs up a little bit faster than what fundamentals suggest.
Yeah, let's go out on this final chart. We ask our readers, where do you think the bubbles are in the market right now, if any? And of course, they think those bubbles are in mega cap tech. They think they're in crypto. They think they're in AI related stocks. This has been the way they felt for a very long time. And housing, they thought was in a bubble forever because housing prices have just gone nothing but higher here. So the fact that we think as individual investors, and we all believe a lot of these assets are overpriced, a lot of these are in bubble territory, getting pretty frothy. When we asked our readers, what stocks would you buy and hold now for the next 10 years? They are right in these sectors. They're crypto adjacent, they're AI related stocks, and they're mega cap tech stocks. So even though we might think things are expensive, it doesn't stop us from continuing to buy the same thing. Your reaction to that?
It's a sort of a perfect illustration of how we view valuation. We get asked a lot about valuation. What does it mean, for forward performance? What do you think the market will do because of X, multiple being this high? For the first thing I would say is valuation is a terrible market timing tool, if such a thing exists. I mean, no, there is no good market timing tool. Otherwise, we wouldn't be having this conversation. But valuation for us is more this tool to look at investor sentiment and how optimistic investors are or how pessimistic they are. And when you talk about some of these areas of the market, whether it's tech, whether it's crypto, having done well for quite a while, quite a few years now, in terms of percentage gains, but also being towards the top of the list when people say, we feel this is overvalued, can't go on much longer. That's sort of the exact illustration we're trying to paint with valuation, which is just that when multiples get stretched, when valuations get really high and really optimistic, it just tells us that investors are willing to pay a lot for stocks, are willing to pay a lot for an asset class. That can last for a really long time. We had that for a good chunk of the latter half of 2020 into all of 2021 until it ultimately became a problem at the beginning of 2022. Similar aspect kind of reemerged in 23 to 24. And then, of course, we had, a pretty significant drawdown earlier this year. So you could date it back to, the late 1990s, that run from 98 up until, to the beginning of 2000. So it's not necessarily that, there's a hard and fast, we've got 2 years until, multiples finally start to break and everything starts to crumble. It's really just sort of indicative of the market environment, the investing environment becoming a little bit more vulnerable to shocks. So I would argue we're getting closer, to the point I made about sentiment earlier. We're getting closer to that, I think, point where we can view it more as a risk, where the ground's a little bit shakier. But it really just tells us when valuations are this stretched and people still are sending flows into these areas of the market, still tells us that they're willing to pay relatively high prices. But we would sort of be on guard for or on watch for some sort of a negative catalyst that can emerge, whether it's labor market related, whether it's now tariff or policy related, because that tends to tip the market in the opposite direction, and sometimes pretty swiftly when you get to these levels.
Cool. Last thing, we'll make it quick with you, and we appreciate the time. What is the one indicator or one thing you don't think people are paying enough attention to as it relates to the performance of the markets and what we might expect for the next several months?
I would say because of all the consternation around the non-farm payrolls report and the revisions over the past few months, I think initial jobless claims have been probably the best key to look at in real time in terms of what firing activity looks like. There's a pretty strong correlation with the S&P or credit spreads and claims staying relatively low. I think if that's still the environment for weekly claims remaining low, probably going to be still supportive of the equity market.
Great stuff. Kevin Gordon, the senior investment strategist with Charles Schwab. Love the research you and your team do, folks. Follow them, follow their blogs, follow them across the socials. Thanks so much for joining the Express, Kevin.
Thanks, Caleb. Appreciate it.
All right, let's get to a little bit of money in motion, because if you haven't been paying attention lately, the IPO market, don't call it a comeback. It's been here for years, but it's really come back strongly this year. We hadn't had an IPO in a very long time. Let's hit a little bit of money in motion. LL said, don't call it a comeback, but it kind of is a comeback when you look at the IPO market right now. We've had an extremely strong year so far, and we're only in mid-August lately. But if you haven't been paying attention, we've had some IPOs here that have had some staying power here. Just look at some of these stats. The first half of 2025, 165 IPOs. That's a 76% increase compared to just 94 IPOs in the first half of 2024. We had a bull market last year. We didn't have a lot of companies going public, but right now they are ready to go. The second quarter so far this year, 50 IPOs, a 16% increase over the second quarter of last year. For the full year, we're expecting over 300 companies to go public in 2025, with about 180 listings in New York alone. They love those listings down at the New York Stock Exchange and at the NASDAQ. But when you look at some of the companies and some of the performance we are seeing, these gains are sticking around right now. And hey, we've seen this before. We saw it in 1995 with Netscape, followed by AOL, followed by Yahoo, followed by all the internet dot bombs. But these companies, these gains are sticking around, and that's a pretty good sign that investors are willing to take on some risk. We'll see what happens when a lot of these IPOs hit their lockup period, because we know things can change very quickly. But right now, IPO market is strong and getting stronger, and that's probably a pretty good sign for the sustainability of this little bull market. It's getting kind of old in months and years. All right, let's get set up for a busy week ahead, especially out west. If you're in Jackson Hole, Wyoming, let's get into some of the things we're expecting this week. You got more earnings coming our way. And as Kevin said, and as we've been talking about, we've been getting pretty strong earnings from a lot of companies in the S&P 500. And if you miss, you're getting punished. But let's get set up for the week ahead. All right, we got earnings today from a couple companies, including Blink Networks. Earnings, retail earnings, big week for retail earnings, with Home Depot and Walmart reporting results this week. Medtronic, I should say, not Walmart. On Wednesday, we're going to get the FOMC minutes, plus Lowe's is reporting results, and Target. More retail earnings heading our way. We'll see if tariffs are starting to bleed into their prices and if they expect to charge us more. And then Thursday and Friday, the Fed's Jackson Hole Symposium. This title of this gathering up in the Grand Tetons is Labor Markets in Transition. That should be a fascinating conversation. I've been to the Jackson Hole Fed meeting before, and it is what you think it is. A lot of economists in zip-up fleece vests, but button-ups underneath, talking econ, talking policy, talking labor markets, but then doing a little fly fishing and canoeing after the meetings conclude. Fed Chair Powell will deliver remarks on Friday. A lot of people are expecting him to tip his hat potentially a little bit in terms of what to expect from the Fed's next meeting coming up in the middle of September, but I wouldn't expect that from Fed Chair Powell. He plays his cards pretty close to his vest, and we know there's a lot of pressure on him. So Thursday and Friday, keep all eyes on Jackson Hole and the Fed's symposium up there. All right, let's get to our indicator of the week, and it's all about credit spreads. Kevin mentioned it when we were talking about it. We haven't seen credit spreads blow out. In other words, we have not seen the difference between the yield between a treasury security, which is considered a risk-free asset, and a corporate bond of the same maturity. Good chart here from Grant over at the Daily Number, looking at the B of A U.S. high yield option adjusted spread and the Fed Financial Stress Index, both measuring credit spreads to a different degree. And if you see credit spreads start to widen, if you see this big difference between the yield between a treasury and a corporate bond, then you know things are getting a lot riskier out there. And that's usually one of the signs we look for when we start to get a little shaky on shaky ground in the stock market right now. But right now, both the Fed Financial Stress Index and the B of A high yield option adjusted spread index are sitting near their lows. And that's probably another good sign for stocks. Anything can happen and a lot of things could change, but keep an eye on credit spreads. And if you want to learn more, Investopedia's got everything you need to know about credit spreads, and our news team will be all over those earnings we mentioned earlier. Big shout out to all the folks joining us from all over the world. We had folks dropping in from Canada. Yeah, this is live on YouTube as well. Call me Vince, live and direct right now on YouTube and then on demand wherever you get your podcast. Shout out to our viewers and our listeners in Canada. Good morning from Auckland, New Zealand, Robert. Nice for you to drop in. Is it really morning over there? Sacramento's in the house. I am Ron One, back in the house. We appreciate you joining in. India's in the house. The Misfit, a regular on the show right now. X-Man's 70 from UK. Good afternoon to you. The trend is your friend, Max Dio. The trend's always your friend until things change, and that's why you got to pay attention. That's why you got to watch your Investopedia Express to see when trends are changing. What about gold and silver? Gino, hey, gold kind of dancing near record highs right now. I talked about the best performing assets right now in the market across capital markets. It's Bitcoin and it's gold. And that should tell you where people are in terms of their risk profile. Riskier folks like that Bitcoin, more conservative folks, they've been buying gold like central banks. What about lithium refining industry? Yeah, we're going to need a lot more lithium. I am Ron One. And you see what these rare earth conversations are all about between the US and China and other countries. Lithium, very big in South America. That is part of the equation. We're going to need a lot more lithium if we're going to create a lot more electronics and AI empowered devices. Houston, Texas is in the house. Fernando, welcome. New York is in the house. Jay Fonzarelli, hey. Texas is in the house. Ryan, thanks for dropping in. Appreciate all you guys dropping in. Denver, Colorado is in the house. What's up, 303? Love it up there. Puerto Rico's in the house. Buenos dias, Puerto Rico. We love you down there in Puerto Rico. Thanks to all of you for chiming in. Love to hear from our viewers and our listeners from all over the world. The Investopedia Express, live every Monday at 10 o'clock Eastern time on all social platforms, streaming wherever you get them, and then on demand on your favorite podcast platforms. Keep chiming in. Keep sending us your comments. We love hearing from you. Big thanks to Kevin Gordon of Schwab for dropping in and dropping some knowledge on us. And we will talk again a little further on down the line.